Hi everybody, in this video I would like to share with you the top investing and career advice by John Paulson. John Paulson is the president and co-founder of Paulson Company and has been one of the most successful portfolio manager in the last decades. He became particularly popular with a trade in which he shorted the housing market during the housing market bubble in 2008 and 7, and where his fund made over 800% return in 1 year, over 60% in one single month. This guy is one of the most successful investors, and he released an interview on the David Rubenstein show the other week. I've seen it, and here are his best lessons. Lesson number 1, if you want to start a career in private equity or risk arbitrage, as he did, the greatest point to start with is a career in merger and acquisitions, because starting in the merger and acquisition section of a consulting company or investing company, you will learn the valuation techniques, the merging techniques, so that once you have your own company or you work for an investment company or wealth management, you know this process the best. And in private equity and risk management, this is a great asset. The second point it outlines to be a successful investor is to have a lot of experience. A lot of training is required, and it takes a lot of time and effort to make it in this industry. He said the most frequent reason why people fail at investing is that they look for get-rich-quick schemes, which is what I say all the time. Have a long-term vision. Think about the company you're investing in a 5 to 10 years at least period of time, so that you can imagine, will it still be here? Where it will be? Will the share of the market it has now change? Will it increase or decrease? He said most investors follow the hype, which is what everyone is tempted to if you think about it. You look at the graph and you see the massive growth in the stock market that a certain company has had. You think, oh my God, this is a great company, it's eating, it's still hot, let's invest in it. As soon as you invest in it, the price deflates and you lose money. So know what you buy. This is the third advice he gave. Define your area of competence. And this is one of the most famous advice also from Warren Buffett. The area of competence. What do you know the best? I tell you the story. I happened to be many months ago on a profile of an investor on the social trading platform eToro, and this investor was just investing in biopharmaceutical companies. So the so-called big pharma, but small companies in the sector, healthcare, etc. I read the bio, and he is a manager and founder of an healthcare company himself. He just sold a portfolio of 30 companies in that sector with the relative portfolio management rules, different percentages for each company. But that's what he did. He studied that, biology or whatever, for at least 5 years. Then he had his experience in the sector. He founded a company, so it's what he knew the best, and he invested in that sector. So he used his competence to invest in it. So invest in what you know, because if you miss an opportunity when you didn't know what you could have invested in, you actually didn't miss an opportunity. We fall in the trap of seeing all these videos. If you invested $1,000 6 years ago in Bitcoin, you would be a millionaire now. I mean, it doesn't mean anything. Did you have the competence at the time to know what Bitcoin was? It could have been for the world? No, you didn't. So, or Google or whatever. This applies to Microsoft, especially tech companies. He then goes on and outlines how inflation has stayed down for a simple principle. Even if the Fed has printed a lot of money, it has not increased the money supply so much in the past years because it bought bonds. So the money supply didn't increase. He said the best indicator for inflation is the money supply. It's not a CPI, which is what most people look at. The consumer price index is the money supply. How much money there's in the system more than 1 year ago, or the time you take into consideration to compare. During an inflation time, he says, the best asset to buy is gold. Because when people leave cash, because cash is not anymore an opportunity, because inflation, if inflation goes up 5% and you leave your cash in the bank, you're losing 5% each year, if it's 5% each year. So it's not a good move. And it's the same for fixed income. So people, as soon as people buy more gold for the supply and demand low, as soon as the demand increases, the price also increases, because there's a scarcity factor that plays in. So he likes gold as an investment, and he suggested, as he forecasts more and more growth in the more and more inflation. Why is inflation not going to stop by the Fed again? Because right now the policy of the Fed have printed money, but increasing the money supply this time, which means that if inflation is temporarily at 5%, it's not going to be temporarily, but this situation is going to stay. And he says that the market is undervaluing it because the market are acting as if inflation was just a temporary thing, and it would go down at 2.5% as it was some years ago. About SPACs, he said that SPACs, special purpose acquisition companies, which are an instrument that are getting more and more used in the recent period, are not in a bubble but are overrated, are overvalued. So he said most people that are getting into it are going to lose money. About cryptos is not flexible at all. He said that crypto, it's a bubble, complete bubble. And the reason he sustains his thesis with is that it has not any intrinsic value, which is what most value investors said about Bitcoin, including Warren Buffett. It has no value, so it's not worth buying. They are not considering the scarcity factor and the technology behind it. Maybe I will make another video about it, but this is his opinion. And it was great that David Rubenstein asked a question. He said, "You're one of the most famous shorters in the history of the stock market. Why don't you short Bitcoin or whatever crypto you want to short?" And he said, because it's too volatile. Because the risk of shorting, so the downside of a short operation on cryptos, so the upside of cryptos is too much in the short term. He believes, by the way, that in the long term they're going to decrease in price, and they're going to decrease by a lot. Last lesson, which is mainly a life lesson that John Paulson leaves us today with, is give back. He said, I loved to give back to the institutions that were important for me. He gave back to the $100 million to the Central Park Association and $400 million to Harvard University.